First of all, I would like to thank the organizers for inviting me for a second time. And as Mr. Vrignot said, I'm also hoping that this event will become a tradition, and I'm very proud to be part of this tradition now, because I'm for the second time here. Alexandru, as the organizer, asked me to speak about the impact of Solvency II on the consumers and on the other stakeholders. And I do believe that this is a very actual question and a very up-to-date question indeed, because we are all eagerly awaiting the 1st of January 2016. Since the adoption of Solvency II in 2009, there has been a lot of talk and discussion about the impact of Solvency II on different stakeholders, on the industry, on the supervisors, and of course, on consumers. The discussion went around mostly the questions: what will be the costs of adopting Solvency II for the insurers, and consequently, this cost, of course, will be borne by the consumers? What will be the expenditure on IT? What will be new approaches, new requirements in respect of corporate governance for the insurers? What new approaches we, the supervisors, would have to apply in doing our day-to-day job? And of course, these are all relevant questions. However, in my presentation, I would like to focus on a particular issue that affects or is arising out of consumer protection, and is, I believe, very relevant in the context or framework of Solvency II. And not only Solvency II, but generally risk-based supervision. And I'm talking now about the assessing or the treatment of conduct of business risks. Firstly, I would like to make some clarifications. To start, all kinds of financial supervisions are primarily aimed at consumer protection. There should be no doubt about it. Of course, I'm repeating what everybody knows already, but we tend to forget the obvious when we lose ourselves in details. So, consumers being the ultimate beneficiaries of protection as provided by the governments or by the European Union in general. And this applies to all levels of supervision. And within the context of insurance supervision, we can talk about market conduct supervision, which is a consumer protection in strict sense, i.e. how the consumers are treated when buying the insurance products. We can talk about prudential supervision, which has been the main focus of most of the European supervisors, i.e. assessing and supervising that the insurers are in a good and healthy financial state so that they can fulfill their promises, their commitments. And also on the level of systemic supervision, of course, we are supervising the system, the financial system as a whole, so that it can provide proper services for the public at large. What Solvency II is, or risk-based supervision, is bringing new is bringing market conduct issues directly into the prudential supervision context. And this, I believe, is an extremely important feature which will affect all of the stakeholders on the market. What I'm talking about, again, is the treatment of market conduct or conduct of business risks. Solvency II, as Katja already mentioned, is a risk-based regime which requires holistic approach to the risks. The regulators and the supervisors supervisory exercise is not anymore box-ticking exercise. We are not checking what has been done by the entities we supervised in the past, whether they were compliant or not compliant. But we have to look forward, what are the risks they are facing today and what will be the risks arising out of their business model in the future. And if such approach is taken into equation, then the insurers have to consider also the risks arising from their direct interaction with the consumers and policyholders. The insurers, by the way of regulation, have to be and will be incentivized to take into consideration those risks and to properly manage them. And now to go more into depth about the conduct of business risks. This has been a major discussion on conduct of business risks in different forums. At the EIOPA level, at the International Association of Insurance Supervisors, i.e. IIS, on the Financial Stability Board, this was also an issue. And this is the result of the recognition that conduct of business presents one of the major sources of risk for the insurers. And moreover, it's now commonly recognized that there exists a strong interlinkage between different kinds of risks resulting from the market conduct. And in this context, IIS has described the conduct of business risks as the risks to the consumers, to the insurers and insurance sectors and market that arise from the insurers and or intermediaries not treating the policyholders properly. Examples of conduct of business risks might be unfair products offering inadequate protection. If I am living on a hill, if I have a house on a hill, I don't need flood insurance, for example. Inadequate disclosure to the clients. In my jurisdiction, there was historically always a problem on the life side of the market that the costs were not properly disclosed. The problem was with bundling of different coverages within one product. The third example is inappropriate marketing or advice. Again, in Slovenia, in the beginning of the 90s, because of the pyramid schemes, this has been a systemic risk. Basically, the life insurance market, which was small but stable, was destroyed because of the inappropriate marketing or advice by agencies, networks. Fourth example would be inappropriate services by the insurers. Fortunately, we have not had this for 15 years in Slovenia, but before, in critical times, there was a policy by insurers not to pay claims to the claimants which are not represented by attorneys, which I believe it's a shameful practice. And these risks may affect or impact directly the consumers, of course, because, for example, a consumer is buying something which he or she does not need. They might affect the insurers because of the penalties, because of the reputational risk, and they might affect the system, as I said, as happened on the life market in Slovenia. And the reason for this high impact, or I would say high level of risk arising out of conduct of business, arises mainly from the nature of the insurance products. And here I would like to, again, to touch upon something which is obvious, but we should not forget. Insurance is an offer-driven product. Nobody wants insurance. If an agent or the insurer comes to my house, he will tell me what can happen to me, that I have to pay something if I want to protect myself, and I know in advance that when something will happen to me, I will not be happy with what I will get. So it's really a product which everybody needs, but nobody wants. So in a sense, the marketing is really in a way forced on the clients. Secondly, insurance in itself is a very complex product. Insurance is nothing but selling a promise, and if, of course, no promise can be unconditional. It's already conditioned on something. And in this sense, it's very hard to predict what can happen to me as the policyholder. And thirdly, there's a huge information asymmetry between the big insurers, which are dealing with big data, which know the market, which know the risks, and me as a consumer not understanding what are the risks facing me. So basically, these are the three issues where I believe the contact between the insurers and the policyholders is extremely important, and it can be a great source of risks for both of them. And how will, within the context of Solvency II, risk-based supervision, the insurers manage those risks? I believe the most important part of managing those risks lies in governance. Again, I'm turning now to IIS and the Insurance Core Principle 7, which is saying that one of the objectives of corporate governance by the insurers is to protect the interests of policyholders. Of course, we understand that none of the insurers which are incorporated with shareholders, I'm not talking about mutuals, is on the market not to make profit. But it should be a prime premise that the policyholders' interests are also an important or even primary part of the corporate governance of insurers. Financial Stability Board mentioned in its paper, which was published in 2013, that reputation should be considered also. of the insurers as a major risk, and reputation has to do all the time with the conduct of business. Within the Solvency II context, I believe what is very important is that Solvency II is introducing compulsory 4 key functions which are part of the system of management. I'm talking about, of course, actuarial function, internal audit, risk management function, and compliance function. And these 4 key functions are covering different risks which also arise from market conduct. And in Slovenia, we are now introducing the Solvency II regulation on a local level. We would like really to enforce this system of 4 key functions of governance within the insurance industry. What we are doing is that we are trying really to make those 4 key functions as independent as possible within the corporate framework. We will give them powers to report directly to the board, and we will give them powers that in gross breaches of regulation, they will have the possibility to report directly to us as the supervisors. And some more notes on the governance. Market conduct risks are not only reputational. Many insurers are seeing market conduct risks only as reputational. If it would be only a reputational issue, this could be managed by public relations tools. We want, as the supervisors and as regulators, and I believe also it's in the interest of the industry, to remove those risks, not to be exposed to them anymore, not just trying to apply a new paint. And what I also believe that market conduct risks have a strategical dimension as opposed to only operational issues. And now I would like to turn what is our role as the supervisors. I'm talking about Slovenian experience. We are shifting our focus from purely prudential issues to the consumer protection. International Association of Insurance Supervisors is working very actively on conduct of business risks within the Market Conduct Subcommittee. EIOPA is now preparing retail risks indicators, which will be the set of indicators like early warning signs on what should be looked upon as the major sources of market conduct risks within the context of particular insurers. And to conclude, we should not get lost in the details of Solvency II. Solvency II is a very technical exercise, and of course it makes sense that it's so technical because we really want to avoid or to lower the possibility of insurance companies' failures. But we should never forget that the consumer protection is the main and actually the only aim of any regulation pertaining to financial supervision. And I believe that the consumer issues should not be looked anymore in a traditional way, i.e. only setting up what are the fair contract terms. Of course, this is extremely important, but should really be looked upon through the risk-based approach. And these risks should be properly managed by the insurers, and we as the supervisors should be in position to understand what the insurers are doing in this field. And just my final sentence is that I strongly believe that with the risk-based approach, the consumers will be much better protected within the European Union. Thank you.